Welcome to this webinar about identifying leading indicators using data mining. My name is Frans and I'm the co-founder and chief product owner at Indizio Technologies. Before we start, I would like to inform you that everyone will be muted during the webinar. If you have any questions, please write them in the chat. I have a colleague, David, with me who will monitor the chat, and in the end, we will have a Q&A session where we will address as many questions as we have time for. After the webinar, I will send out this presentation as well as a recorded version of the webinar. Let's start. Why using leading indicators? We have seen in our studies that using leading indicators can improve the forecast accuracy by 40 to 60%. I will tell you more about this accuracy benchmark in the end of the webinar. The agenda for today: we will start with a short introduction to Indizio. We will then jump into identifying leading indicators and the commonly used methods. I will then do a short demo how this is applied in Indizio, and I will then actually have a webinar offer for everyone joining this webinar today. The story behind Indizio in short. For 6 years ago, I worked at the OEM evaluating their forecast accuracy. I realized that a simple statistical model could outperform not only the internal forecasts, but also the forecasts from international experts by at least 50%. Later on, I tried to find software that applied these models suited for non-statisticians. I found nothing. That's when I teamed up with David and Daniel to build the best forecasting platform for non-statisticians. Our technology is today applied within automotive, construction, and finance. One example is Volvo Trucks that applies Indizio for market forecasting. And before they become a client of ours, they did a very thorough investigation where they benchmarked the Indizio forecast towards their internal historical forecasts. It showed that Indizio was not only more accurate, it was also enabling them to forecast market trend shifts months earlier. This meant a lot for them because with this information, they could adapt their whole production months earlier. Another example is Skanska, a construction company that used Indizio for real estate price forecasting. These forecasts are used to make decisions upon what projects and when in time they should start. It's a function just underneath the management board, pretty much the same as in Volvo, so it's very strategic forecasting. And forecasting that could be applied in many different levels. Either the strategic forecasting done upon 1 to 5 years ahead, typically used in business plans, sales and marketing plans, and for strategic investments. You also have tactical forecasting 2 to 12 months ahead, typically used within demand planning, capacity planning, inventory planning, and financial planning. And the last, we have the operational forecasting done upon 1 day to 2 months ahead, typically used for order management, logistic planning, production scheduling, and material planning. The future of forecasting. For about 30 to 40 years ago, most organizations started to collect data. This data was later on cleaned and were presented in some standard reports. These are today digitalized into what we today call an ERP or a BI system. And these systems, they contain some forecasting capabilities. Unfortunately, the models that makes these forecasts are optimized towards describing the future, the historical development rather than the future, and which is also what makes them less accurate. Today, we are at the first white dot, where a lot of great predictive models has emerged, mainly from the 4th generation machine learning research. These models are optimized towards describing the future, which is also what makes them more accurate. Adding to this, we also see a trend going up towards the right top corner, towards optimization, where you can optimize for a certain outcome. An example of this could be that you have forecasted your sales for each country in Europe, and you're now sitting in production planning and you would like to optimize for a certain outcome. It could be optimized towards gaining market share or increasing revenue. So we see a clear connection between having the predictive models and having the optimization engine. And Indicio is positioned in between. Today we have great predictive models, but we're also building an optimization engine for our clients. Identifying leading indicators. What is a leading indicator? A leading indicator is a variable reacting prior to your sales, for example, and can therefore be used when forecasting the sales. As you see in the plot, the orange line reacts prior to the blue line with a time difference, often called a time lag. It's this relation that makes it a leading indicator, because it says something about where the future is going. Unfortunately, the reality is not always that simple. First of all, it's, as you see on the plot, it's not possible to identify the leading indicators just by looking at it. Secondly, a leading indicator frequently changes over time. And the relations are seldom just as easy as a one-to-one relation. The first method to solve this that I will go into is the smoothing technique. The smoothing technique, such as a moving average, will solve this by just smoothing the line, which makes it easier to see the lagged relationship. However, as seen in the plot, the smoothened line, which is the dotted one, has a delay to the original one. But if you're comparing this to the actual, you're seeing that the smoothened line actually reacts much later. So this method is actually turning to not being a leading indicator, but to being a lagging indicator. It reacts post your sales, for example. Another commonly used method is correlation, and more specific, the lagged correlation. As seen in the top table, lagged means that we have moved the indicator column down 1 month to test if the indicator value for January correlates with the registrations for February. These results are presented in the colored table. Here we see that 1 month lagged inflation, HICP, is correlating with the number of car registrations. The positive aspect of this method is that it's simply to use and also to explain. The negative aspect, to forecast, for example, 12 months ahead, you need to identify indicators for the first lag and for the second lag and so forth up to 12, which is very hard. Therefore, the forecast horizon is often limited. Secondly, it's based upon correlation, and the result might be contaminated by funny correlations, which is when two variables are highly correlating but without a causal relationship. And since we only measure the correlation between the car registrations and one indicator at a time, the group effect, the effect of how two different leading indicators together can forecast the registrations, are not captured with the correlation. Lastly, it's hard to translate a correlation number to actual forecasts. It's kind of a mystery, often done with a subjective influence. Next method is by using a forecasting model. And bear with me, this is the only statistical slide that I have. By using a forecasting model, you will not be limited to the indicator lag when forecasting, since it also forecasts the indicators. It also captures the group effect. It penalizes funny correlation, and you can use the results to forecast. And it's quite easy to verify the results as seen in the plot, where we have each colored line is a historical forecasts where this model has been applied. And it's a forecast can never be 100% accurate, but as you see in the graph, I would say it's close to it. It even captures the turning trends. However, a forecasting model has a bias to often include too many indicators, and we therefore need to look for another method. One of them is applying a searching algorithm. I firstly saw this when an economist showed me how she evaluated a leading indicator by using them in a model and then tried to remove a variable and then measured the accuracy effect. This is called the backwards search, when you start by having all your indicators in the model and then removing one and measuring the effect. Another searching strategy is the forward search. And there you start with no variables, and then you add a variable and you measure how the accuracy is increasing by adding. And the last one is stepwise search, which combines the both of them. It's both adds and removes variables and measure the accuracy change. This gives us the possibility to optimize for making an accurate forecast when identifying leading indicators. As I started with this webinar, we have benchmarked this method multiple times. This is one example where we benchmarked the indicio forecast towards an internal used forecast method, where we're able to decrease the percentual error from 6.5% down to 3.3%, an accuracy improvement by 50%. The reason for this improvement is rather a better forecasting processes where each sub-processes will improve the final outcome. And here we see the processes where in these you start by cleaning the data, identifying the leading indicators, benchmarking all of the models applied, and then weighting the results according to the accuracy of each model. Now it's time to see this in action. So I will log into Indizio. Indizio is a web-based platform, so you can access it from wherever you are situated. And the idea behind Indizio is that it should be easy to collaborate across different departments. You do this collaboration in different projects where you can easily invite your colleagues by adding their email address and setting the role that they should have in this project. You can then fill this project up with forecasts. And start by setting a name. You set the time horizon, the forecast horizon that you're interested in. I'll say monthly, moving 6 months ahead. Great. The first thing that we need to do is to add the variable that we would like to forecast. And here you see all of my variables that I previously been using. You can also upload Excel files. And here Indizio visualizes the content of the Excel file and also guesses the content. So in this case, it has recognized that the first row contains some text and the first column is a date and the second one is a value. So it's quite easy to work with Excel files. And you can also pick data from different data vendors. And here, the data vendors, we have both free data vendors, such as FRED, the Federal Reserve Database, and we also have paid data, where you need to have your own credentials to use their services. Just for this simple demonstration, I will use a variable that I've already used before. Let's say passenger cars in Europe. The first thing that Indizio is doing, it's that it cleans the data. It looks for missing values, for outliers, and for seasonal pattern. In this case, Indizio has identified that we have a seasonal pattern. And usually, when you have a seasonal pattern, the common way is just to remove the seasonal pattern and then to communicate a seasonal adjusted forecast. But as an industrial company, this seasonal pattern is really important. So in Indizio, we actually saves the seasonal pattern and you can then put it back on to your forecast. So in this whole data cleaning processes, you will not lose any information. The next step is that we apply the univariate forecasting models. I can jump into that. These are models that is only basing the forecast upon the historical development of car registrations in this case. So it's very simple models. And here we use classical models such as Riemann exponential smoothing, and also newer ones such as neural network. And quite interesting to see is the exponential smoothing is the most commonly used model within the BI system. And here you see that it's crossed out. It's actually been excluded due to our quality measures on each model. But these are very simple models. And the next step is that we're going to try to outperform these models by adding leading indicators. And I've actually already, so it's the same processes when adding an indicator. So we can add economic sentiment, for example. And it will go through the same data cleaning processes. So I've already prepared a forecast where I filled it up with different indicators. And I have run through our indicator analysis. As you see, the results of the indicator analysis are the stars, which is pointing out that we should consider the consumer confidence indicator, new car registrations when we are forecasting the heavy commercial ones, economic sentiment indicator, and economic sentiment indicator from another source, I believe. We also see that the PMI from the US should be excluded, and also the total vehicle sales in US. And to do this analysis, it's just a click of a button. And for those who are technically oriented and would like to look at the different strategies for picking the right indicators, we have those here. So default, we use the stepwise search that I presented earlier. So the next step, when we have identified what is leading this market, is that we can use this information to forecast. So then we click on the multivariate analysis, and it triggers up all our multivariate models. Which you see here. As you see, all of the models gives very different results. And I can imagine as an organization, you would like to have one forecast to communicate and not 30 different forecast results. And we solved this in the last step, where you can weight each of the model results, either by putting an equal weight to it, or you can actually base the weight on the accuracy. So if a model is more accurate, then it will have a higher weight. So here, for example, the weight for 1 month ahead forecasts are weighted. So it could be that one model is performing best in 1 month ahead and another model is performing better 6 months ahead. That's the main processes in Indicio. We also have scenario analysis, where you can run scenarios upon what would happen with this market if the PMI numbers keep on falling, for example, to run that scenario. And we also have support for manual adjustments. So you can add manual adjustments to your forecast. I can actually show you that one because it's very, very good. So here, for example, if you would like to use your gut feeling at the September forecast, and you would like to have this 0.6% higher than what the statistical models are saying, you need to fill out the source, why you believe this. For example, that you read in The Economist that we're going to have a higher export. You set the category to economically, and you set how much you trust this source. And the good thing about adding the assessments in Indicio is that we will follow up and analyze them. So when we have the actual outcome for September, we will compare this to all of your assessments, and we will give you feedback. For example, the source that you are referring to might not be such a good one when forecasting the heavy vehicles. Or it could be that you put too much trust on it, or that all of your assessments from the economic category seems to be less relevant. So it's a lot of great feedback from this feature. And also, if you have, it's quite common that the forecast is used in another part of the organization. And it could be that someone from that department would like to add an assessment. And then it's just very easy to invite them into Indicio. They will make their personal assessments and they will get personal feedback. So it's also an organizational learning connected to it. That's pretty much it of a short demonstration. Of course, there's a lot of more features, but let's take those in a later stage. So now to the webinar offer. For everyone here today, we are offering 3 free case studies amongst the first 10 to register. So we will take your data, run it through Indicio, and see how much we can improve your current forecast method. This includes a dedicated market analyst. We will give you the presentation and all the material, and you will get insights such as what is a leading indicator in your market, seasonality, and effects of policy changes, for example. The requirements are that you need to supply the data for which you want us to forecast. And here we are open to writing a data NDA, a non-disclosure agreement. We will also need you to supply some of your old forecasts, so we have something to benchmark it towards. And we need your manager to be committed, or some manager with a budget to be committed in this small project. Great. So let's take some questions.
Great, and great presentation, Frans, and we've been getting a few questions in the chat, so that's really nice. And I will lift most of them, I think. So starting up with a question from Philip, where is the data stored that Indicio uses?
Yeah, that's a good question. So as you probably realized by now, this forecast can be very sensitive, especially if you're forecasting the sales and it's a publicly traded company, that could be extremely sensitive. So we have the highest security policies in place. And the data is stored in the cloud.
Great. Another question here from Cliff. Is there a UI feature for the historic correlation, in example, structural changes of the actual time series data?
Good question. We have something called a rolling window in our indicator analysis. So you could apply the rolling window, and that will pretend that it's 2015 and run which indicators was best suited at that time. And then it will look at the next point in time, and you will get that as a graph with a chart with all the indicators. So you will see how good they have been over time.
Great. Another question also from Cliff. How do you prevent spurious correlations beyond significance measures?
That's a good question. So we handle it by using something called a lasso model, or a group lasso model. And that it's kind of a new model. It's like 5 to 10 years old, and it penalizes the parameters in the forecasting equation. And this penalization is it's penalizing a lot of the spurious regression, and it all depends on the amount of indicators. So it's the first step towards penalizing spurious regression away, and here we are limited to the forecast research. So it's the latest model.
Great. From Philip, do you have any track record forecasting the automotive industry related to the COVID situation?
Yeah, so it's very new, I would say. We will have a track record soon. And I mean, the effects of the COVID, we could never have forecasted the COVID-19. However, now when we start seeing the effects in the data, we can use that in the Indicio. So in Indicio, you can add events such as COVID-19, or for example, emission legislations, and the effects of those events will also be modeled.
Great. One question from Adrian. How do you help us in choosing the right indicators in the case study?
Yeah, good question. We will do it in a discussion with you. So we will provide what we have seen are commonly used indicators good for forecasting the automotive industry. We're also working on a feature in Indicio to recommend good indicators automatically.
Great. From Cliff, could you elaborate some on the methodologies used as a baseline in the case study you mentioned, where Indicio improved forecast accuracy with 50%? What was the methodology benchmarked against?
Good question. So it's what benchmarked towards a forecasting model built in Excel. And they put it quite much time into these forecasting models. They had external consultants for building this massive Excel sheet. So they identified the leading indicators using correlation, and then they had kind of a weighting scheme where they manually outputted different weights on the indicators based on the correlation. And they then had an equation in Excel. So it was a very thought through Excel sheet. But Excel is limited to its capabilities. But in the beginning, we didn't thought that it was going to be that much of an improvement since they had put it down so much time into their current model.
Great. Another question from Cliff. Can you explain your unique selling point to competitor Preveder?
Preveder.
Preveder.
So I don't know that that supplier. I mean, I can compare it. We often compare our platform towards a data science platform, and there we have a competitor such as DataRobot, and they are very similar to what we are doing. So they are automated the models being applied, so you do not need to have deep knowledge in how to apply a statistical model. The difference between them and us is that they are turning towards a data scientist. So you will have a lot of technical details in their platform, which could be confusing, while Indicio is automating this to another extent. So we are typically aiming towards clients that has a deep knowledge into their market. They have a lot of ideas what is driving their market, but they lack the technical part or the statistical part of it. So that is one comparison to a current competitor.
Great. From Cliff, you can label data good, but will all the subscribers benefit from that, or is it model specific?
Could you elaborate on that?
Yeah, perhaps we can do that in the chats, and I will take another question in the meantime. So a question from Ron. You mentioned limitations on multivariable correlations. Can you expand on this?
Yeah. I don't know what limitation you're referring to, but for example, the group effect, saying that you have done this correlation analysis and you have say 5 indicators which are highly correlating. It could be that these 5 indicators are carrying the same information, and in correlation you do not know which of these 5 that you should pick. So that is one effect that is covered if you put it into a forecasting model, that it will penalize the variables that contains the same information as others. Another limitation is that correlation is only looking at a relation between the forecasted variable and one indicator. And it doesn't consider that if you are, for example, the PMI together with the IFO index, those together and only together brings a high forecast value. That type of value will never be captured looking at correlation.
Great. So now we got an elaboration from Cliff on the previous question. So we mentioned event like policy labeling. The question is, will this label be used for model building among all subscribers, or is this labeling customer specific?
Okay, yeah, it's customer specific. So you will have your own events. You will share the events though within a company. So the COVID-19 might be maybe I can show that feature just quickly. So here you can add event group. And here I've, for example, added emission legislation. And to this event group, I said that it's affected the European market. It's a typical political event. And we have the Euro 2 to the Euro 6 events in this group. And all of them are, the effect is a lagged spike. So typically you see it's called a pre-buy effect. So when the emission legislation is about to be implemented, you're seeing that the sales of the old trucks are peaking in sales. And then just after the implementation of the legislation, the sales are dropping. So therefore it's called a lagged spike. So this group events are shared within a company and is used in both identifying the leading indicators and also to forecast the commercial vehicles in this case.
Great. So I think we are at time's end soon, so we will have one last question from Adrian. Can you give me a list of parameters which we need to take into account in order to identify the leading indicators? And also, do you have a standard percentage number for best leading indicator that has the highest impact on our main variable?
So since we have done quite many forecasts by now, we have an idea to test different indicators. Those indicators typically are such as the PMI, the Purchasing Managers Index. It's a survey going out to different purchasing managers, what they think about the future based on the orders that they place from the subcontractors. So that is a typical leading indicator for the economy, where the economy is heading. And it's typically different type of those surveys that we typically add. Now during the COVID and also a bit prior to the COVID, we have seen that a good indicator could be a volatility index from the financial markets. What more? Yeah, so we have kind of some standard indicators that we always are trying. And then it's always customer specific, especially how much data you have available, since you could combine both internal and external data and get the most value out of both of them. So it's still a discussion to finding the best leading indicators.
Great. So I think we have answered all the questions, and I see that it's only 1 minute left. So yeah, I think we close the Q&A for now.
Yeah, great. So thank you a lot for participating in this webinar. I hope that you find it interesting, and I hope that you will contact us if you have any further questions. And for those of you who are interested in the case studies, you can register at indisio.com/case study. Great. So thank you for today.